In this video I want to explore a topic that usually causes some controversy among traders. I noticed that many people who approach me to ask questions about trading are usually concerned about the situation regarding multi-timeframe analysis. In other words, traders in a certain stage of their learning curve will inevitably think that changing between timeframes in a frantic manner is part of the solution for their problems. This concern usually comes from the fear of missing out an important support and resistance level in a higher timeframe, and a more accurate entry and exit point in a lower timeframe. Even though this preoccupation is understandable, changing between timeframes while you are trading tends to create the famous analysis paralysis problem. To understand why that happens, we need to put a few things into perspective. If you take a look at the last two videos I uploaded to the channel, you will inevitably notice that it is possible to extract a huge amount of information from a small piece of price action. In other words, if you know how to analyze price from different perspectives, you will be able to see many different details, and you will also need to employ a lot of work to put all these details into the proper context. That's the case if you only look at approximately 200 candles of price information, which is usually the necessary amount to find reliable trade opportunities. Now imagine what happens when you increase the amount of price information you have to consider by changing between timeframes. Beyond the loss of perspective, you will dramatically increase the amount of information that you have to derive and put into context. It's not a surprise that this sort of thing leaves traders paralyzed. There is too much to consider, and it's not clear what you should look for when you change timeframes either. This sort of situation tends to increase the level of subjectivity in a trader's analysis in an unnecessary way. If we stop to think about this whole paradigm for a while, we will see that when traders change between timeframes, they are employing a quantitative solution. In this case, a quantitative solution will only increase your problem. In other words, your analysis will not get any clearer if you keep adding dense price information to the table. The exact opposite has to be done. You have to decrease the amount of price action you look at by limiting the number of candles visible in the chart, and perhaps most importantly, by sticking to one timeframe only. If you do this, you will immediately put yourself in a reliable and realistic playground to create a good analysis of the market, and you will notice that your job will become a lot easier too. That means that your analysis will become simpler to make, but remember that simple does not mean easy. You can think about this in another way as well. Imagine that you will play a game that has too many rules and too much going on at the same time. You inevitably freeze because the amount that has to be done in this sort of game is just so overwhelmingly great that the brain will not be able to cope with it in any realistic terms. However, if you play a game where the rules are simple but difficult to master, then it's only a matter of getting better at those simple rules. It's a much more realistic way of thinking about trading. In the fractal flow strategy, you will notice that I say that one of the trading principles is indeed timeframe analysis, but you have to be cautious to interpret what that means inside the context of the strategy. I created the concept of the fractal candle to solve this problem of seeing what's happening in adjacent timeframes without actually changing to other timeframes. This creates sort of a funneling effect where the appearance of fractal candles creates these inflection points in the chart that condense the information from multiple timeframes at the correct place and time, so you don't have to keep changing between them all the time to confuse yourself even more. The same thing tends to happen with pure price action reading. If you understand the language of price without any lines or indicators, you will be able to see lower and higher timeframes without actually going to these timeframes. This takes some practice, but it can be done quite effectively. To sum up the narrative of this video, you should constrain and limit the amount of price information you will analyze in order for your complex and rich analysis to become realistically doable. Take small pieces of price action and attempt to extract as much meaningful information as possible from this segment of price. You will be surprised at how much you will be able to tell about the market assuming you can analyze it from different lenses. If you enjoyed this video, please click the like button, subscribe to the channel and leave your comment below. Thank you for watching and I hope to see you in the next videos.